As the International Monetary Fund and the World Bank hold their meetings, what can we expect for the global economy? Hello, I'm Mike Walder, sitting in for Anna Naidu, and this is The Heat. They happen twice a year, the International Monetary Fund of the World Bank meetings. The spring meeting is now underway here in Washington, D.C., and the IMF is warning the global economy can expect headwinds in the year ahead. CGTN's Jim Spellman reports.
The global economy faces an uncertain near-term future that, according to the International Monetary Fund's annual World Economic Outlook.
Serious financial stability-related downside risks have emerged. In our latest forecast, global growth will bottom out at 2.8% this year, before rising modestly to 3% next year, almost unchanged from our January projections.
Key challenges include the conflict in Ukraine, lingering supply chain issues related to the COVID-19 pandemic, and financial sector turmoil. Inflation remains a threat.
Inflation is much stickier than anticipated, even a few months ago. While global inflation has declined, this reflects mostly the sharp reversal in energy and food prices. But core inflation, excluding energy and food prices, has still not peaked in many countries. It is expected to decline to 6.2% this year, still well above target.
The IMF is encouraging central banks to continue fighting inflation while remaining flexible should conditions change.
Central banks should use available tools to address financial stability risks, which should help them to separate monetary policy objectives from financial stability goals. And this should allow them to continue to tighten policy to address inflationary pressures.
The U.S. economy is expected to grow at just 1.6% this year and 1.1% in 2024. Europe faces modest growth as the region deals with impacts from the conflict in Ukraine. China is a positive note in the economic outlook, with solid growth expected as the country reopens after lifting COVID restrictions.
On China, we have, of course, this is one of the bright news for 2023. The rapid reopening of the economy is leading to a strong rebound. So we're projecting 5.2% growth in 2023. That's up from 3% last year. So very clearly, very significant effect. And of course, still some slack in the Chinese economy. So inflation pressures remain quite modest, and we anticipate that there will be mostly around 2% this year and next year, increasing a little bit, maybe next year 2.2%.
The IMF also projects that China's reopening will help ease lingering supply chain challenges, helping economies around the world. Jim Spellman, CGTN, Washington.
Well, we have a lot to discuss. Let's bring in our panelist. Otaviano Canuto is Senior Fellow at the Policy Center for the New South and former Vice President of the World Bank. He joins us from Potomac, Maryland. From Los Angeles, Ryan Patel is a global business executive. Vicky Pryce is an international economist joining us from London. And Qiang is Assistant Director of the International Monetary Institute. He is joining us from Beijing. Welcome to the broadcast, one and all. Otaviano, you're a former World Bank Vice President. You've been to a lot of these gatherings. Give us a sense for our viewers why they're so important. What do you look for as key takeaways from these gatherings?
Look, it's a pleasure to be here again. The fact of the matter is that you have this discussion on the global economy that always happens as the institutions release their forecasts and so on. But the agenda to be covered over the weekend by the ministers will be more on two other topics. One of them is the different views on whether to reform multilateral institutions, particularly the World Bank. And the other topic will be definitely on the table, will be the situation of debt of countries that are currently facing distressed financial situations. I don't believe the spring meetings will be very, very conclusive in that regard, but it will, let's say, lay the ground for the annual meetings that will happen in October in Marrakesh and Morocco. And until then, it will become more clear what to do with respect to the World Bank itself, as well as how to do, if anything, with the situation of indebtedness of many developing countries at the time. But the forecast that came out yesterday and today, they were not surprising at all. As we all expected, a certain decrease in the growth rate this year as compared to the historic average. But nonetheless, attention was called to the potential stresses that might come on the financial sector side. The great unknown at this moment is the extent to which the banking troubles of last month and potential new source of stress on the financial side might lead to a credit crunch, let's say, in addition to the interest rate hikes. That's why even the opinions of the officials of the FOMC are divided on whether the interest rate hikes have already been enough on the West side.
Yeah, Ryan.
Nobody has.
Ryan, to that point, you know, these meetings in Washington, they're talking a little bit about the banking system. We had the collapse of these banks here in the United States. Not a lot of them, but still we saw them. The IMF is describing there's some significant vulnerability. Just today, the Swiss Parliament rejecting the Credit Suisse rescue plan. It was a symbolic vote, but nevertheless, they rebuked this effort to prop up that bank. How big a concern is this, would you say?
Well, symbolic it was. I mean, we knew that was going to occur. I mean, the issue, I guess, when you think of what the IMF just said, they assumed that there was going to be the financial sector stresses were contained. So when we start to see, not that specific instance, but other instances that there may be some more cracks, don't be surprised if this is going to be a revised statement of what the outlook is going to be. I think it's really clear that, you know, the financial sector is fragile. I hate to use that word. It is fragile because of the way that it happened just a couple of weeks ago, Mike. If you and I were talking about this 2 weeks ago about the financial sector, you know, we'd be worried to say it's all contained and we're 2-3 weeks apart from it. I think when economies and inflation start to occur, and you mentioned, I know it was only a couple of banks in the U.S. Unfortunately, it called questions to every bank, to regional banks, to talk about the financial system, how it can be propped up. So we are at these times where it was a unique situation, which I don't think is going to go anywhere, and to get that credibility and trust back in to grow the economy back to where you want those high numbers, it starts from there.
Ryan, you know, the U.S. Treasury Secretary, Janet Yellen, seemed to be trying to calm jitters. She thinks that the outlook is reasonably bright. She said that she wouldn't overdo the negativism about the global economy. That's despite the fact that the growth here in the United States is going to be anemic. It's going to be about 1.6%, even less next year. I think just a little over 1%. What do you make of her words, and what do you see in terms of the global growth? I mean, not the global growth, but the growth here in the United States?
2 words, cautiously optimistic, is I think that's what she said, or at least I would describe. I think that's fair because you can't expect the U.S. growth to be back to 2-3%. I think when you think of medium growth, that would be the highlight for the next 2 years, and you have to be okay with it. I think the U.S. economy has to be okay with it, and I think they are, based on what they're trying to set up for a larger growth. You're fortunate, the U.S. economy is fortunate, it's having some growth and some stability. I think the main key here, Mike, for the U.S. economy is to get the foundation back, build its supply chain, build its other infrastructure internally to ensure that they can handle the current situation when it comes to from unemployment to inflation, to get the core prices back and then start building and not kind of run before you walk. So I think when you think of the next 2 years, I think those are targets that are at best, you know, they're not trying to overly achieve something. It's to make sure that they achieve those small baby steps so they can start growing in the future.
Vicky, you know, she's trying to be optimistic, but the IMF's chief economist, we heard from him in Jim Spellman's report. He's also quoted in the Financial Times as saying this, and I want to get your thoughts on this. He said, below the surface, turbulence is building and the situation is quite fragile. Inflation is much stickier than anticipated just even a few months ago, he says. More worrisome is that sharp monetary policy tightening of the past 12 months is starting to have serious side effects for the financial sector. Those sound kind of like dire words. We hear so much here in the United States about a soft landing. That doesn't sound like a soft landing.
Well, it doesn't. And it's interesting because the IMF is talking about divorcing, if you like, what the central banks do on the monetary side and controlling inflation and also the financial stability side. Well, the two, I'm afraid, are linked. What we have seen in the last few weeks is that the very sharp increase in interest rates that the central banks have put in place, but also, of course, what's been going on in the bond market with yields going up very significantly, have affected the banking system quite negatively. And this is really the problem that we've got at present. At the same time, of course, if you're trying to control inflation, you may also want to control perhaps the amount of lending that's going on out there. Well, if that lending gets reduced anyway because nobody trusts each other in the banking sector, and there are more regulations which are going to be implemented, and I'm pretty certain that the whole non-bank sector is being looked at much more carefully right now. Well, you are going to have a slowdown in that lending happening and a slowdown in the economy anyway. So the two, I'm afraid, are very linked, and trying to separate them is not very easy. And I'm slightly surprised about what the IMF has said, given that just a few weeks ago, maybe even a week ago, they had produced this blog which was saying that they're really worried about this very sharp increase in interest rates that's taken place, and blaming that up to a point for the problems we've got, and actually asking for more regulation to take place so that we can get some of those issues perhaps sorted out for the future. And they are worried about it, there's no doubt about that. And in a way, what they've got right now in terms of the forecast for growth, which have been reduced slightly from where they were late January, are reflecting very much those concerns that they've got right now.
And how concerned are you about the banking sector?
I think there is no doubt that the banks are considerably better capitalized, certainly the bigger banks. The real issue is what happens with the smaller ones, the ones that are perhaps focused on supporting the tech sector, as we've seen, certainly with the Silicon Valley Bank, cryptocurrency focusing some. Again, we've seen some problems there emerging. But the bigger banks are well capitalized. There is no doubt about that. Since the financial crisis that we saw in the late 2000s, then we've had great changes taking place. But with that, I'm afraid, has also come the fact that everyone is trying to encourage, new institutions, if you like, to be set up to support startups, to support the new innovation that is required in the technology sector in particular. And those have tended not to be so tightly regulated. And I think that's where the problems come.
In Qiang, China, of course, a different story altogether. We're hearing their projections. I think it's about 5.2% growth they're looking at this year. That's pretty much in line with what Beijing is targeting, although we've had a number of people on our shows in recent days saying that they think it could even go higher than 5.2%. This is likely to have a ripple effect in terms of supply chains. Also, it could help neighboring countries. When you think about pent-up demand of Chinese tourists who haven't been able to travel for a while, going to other countries, that could help tourism there as well. Kind of give us your outlook at what you see in China as far as its economy and kind of the ripple effects as it, basically the tentacles moving outward.
Well, absolutely, you're correct. And I think IMF will have their reasonable predictions about it. First of all, I would like to mention the key word is about the comeback to the value chain or supply chain. So as you mentioned, if you go around China, you will see everything is back online and people are working, restaurant is opening, tourism resort is full of people. And so this kind of a supply chain is providing the product with, good qualities and affordable prices back online to the world market. So this is a great news because it's helping the rest of the world is pulling down the prices, and also it's making profit for the Chinese economy. And the second thing we're talking about is about the market. We're talking about 1.4 billion of people. One of the biggest market in the whole world is back online, which is also a good news for the world supply chain, for the European market, for the ASEAN country market, for North America. It means your services and products can sell back to China again, and also you'll be seeing the Chinese tourists and also the Chinese, people going back to the shopping mall all over the world. And also the third thing I would like to mention is about the capital, which is not a usual keyword. I would like to mention about Chinese economy and its ripple effect. But right now it is, because with, what we've been seeing in America and in Europe about the recession, about the inflation and the tightening up of the monetary policies, we've been seeing the capital has been withdrawing from the major economies in the West. So as our dear co-worker just mentioned, it's going to affect the SMEs in the emerging markets and also the tech startups in those regions. For example, we've been seeing many small businesses and also tech startups in the Middle East and Israel, in ASEAN countries, Indonesia, and Malaysia, Singapore. It's been, suffering from, the withdrawing of the capital. China, when it's back online, and also when China is in a different phase of the monetary policy, so it still keep on expanding on the monetary supply, which means it can supply the capitals through the projects to those adjacent countries. That can be a great news for the SMEs and startups in those regions. For example, we've been seeing many Chinese companies that's been going out to the ASEAN countries, starting the operations, branches, and the startups in those regions, and supplement all those capital supplies to those companies. So with all these factors, I think it's going to be a good news for not only China, but also the rest of the world.
Otaviano, I've talked to you in the past, and you're rather bullish about the economy in China as well. And you say that the growth patterns in China, in past broadcasts, you've said you think that they can impact Latin American countries as well. Can you expand on that? I mean, are they likely to benefit as well?
Yeah, yes, indeed. China has become the major trader for most countries, particularly in South America. And obviously, with the Chinese economy doing well, that boosts the prospects of rising exports and so on. What I remarked in our previous conversation was to call attention to the fact that the pattern of growth in China is also changing, and this has implications. For the future, as China grows, it will be more dependent in its GDP creation on service. It will depend less on manufacturing. It will be less dependent on exports and imports. And as it moves up the value chains and as it goes to the frontier sectors when it comes to technology. So the pattern of demand to the rest of the world from China will change as it grows. And also, as I highlighted, now China is on another path of growth that is not the two-digit figures of the previous decades, and shall move towards something in between the range of 3.5 to 4% growth a year. So it's benign, but it is changing, and the outsiders have to adapt themselves to this new feature of the Chinese growth.
You mentioned the word change. I know that you've been very active in trying to adopt some changes. The IMF and World Bank created in 1944. That's almost 80 years ago. Your organization, Policy Center for the New South, is part of a group that's analyzing reforms for these institutions, a goal to give more of a voice to developing nations. Talk to us about the importance of this process and also the difficulty of trying to change institutions that have been around for so long and are kind of married to the way they've been doing business for so long.
Oh, right. And, I spent 15 years in several capacities, either as being elected by countries or as a vice president in the staff. And the thing is, the institution needs to adjust its mission. Definitely, there is a strong will by shareholders that the institution ties a bit more or much more what it does to global public goods, such as climate change, to be seen how to conciliate this with the traditional demand coming from the client countries. And the institution will need to raise up the level of funding that it can portray to the countries. I was there at the time of the last capital increase. It has been used up, so the institution needs to find sources of funding in order to comply with its mission. And then comes, there is the possibility of new round of capital increase for the institution, which is not easy. And also there is the call for the institution to be, let's say, less risky averse and sustain levels of lending, let's say, more stretched vis-a-vis its capital. And but the challenge faced by the institution is particularly in finding resource and redefining its mission.
You know, Vicky, we spent a lot of time talking about the United States and China and the economies there. Let's talk a little bit about the UK, because what we've been seeing recently are these picket lines. So many people out on strike, folks kind of disheartened by kind of this double whammy, not just inflation, but also, you know, the conflict in Ukraine, and suddenly it takes a lot more money to heat your flat. You know, that's one issue. There's a number of other issues, you know, unemployment, inflation. IMF's predicting a contraction. How do you see things there in the UK? How dire is the situation?
Well, it's interesting you mentioned unemployment, because that's perhaps a positive story, because unemployment is at almost record lows. So the economy is still pretty resilient despite everything, but there is no doubt that there are some issues in particular that the UK has had to face. I could talk about Brexit, for example, which of course has meant that some of the supply chain issues, we discussed those earlier with your other contributors, they have been worse here in terms of their impact on inflation in particular than has been the case in Europe. We've lost lots of people who used to work here pre-Brexit, and now of course they haven't come back, particularly after COVID, and there is a real shortage of skills across the economy. And that's one of the reasons why we have also, in addition to the supply chain issues, higher inflation than perhaps is the case in loads of other countries in Europe. And that, of course, has also kept interest rates quite high. And in addition, you mentioned Ukraine. Yes, the interesting thing is that, of course, gas prices have gone up internationally. The UK relies a lot on imported gas, even though there's also internal production. But we don't have much nuclear. There's a bit. We certainly don't use coal, anything like what some other countries are doing. In fact, all that is stopped here in the UK, more or less. So gas is the main element. Of course, there's also oil that comes in. So those factors have contributed to the UK doing slightly worse than others. And it's one of the reasons why both the government itself here, with its advisors, the analysis that's done by an independent organization called the Office for Budget Responsibility, and also the IMF, agree more or less the same forecast. In one case, minus 0.2% and 0.2%, and the other one minus 0.3%. So we're basically in the same ballpark of decline this year. But of course, anything could happen. You mentioned strikes. There's no doubt that those have affected the economy negatively. If they finish quickly, then perhaps there will be a bounce back. So there are, quite a lot of sectors still doing very well, such as entertainment, travel, and so on. So there is quite a lot of demand in the economy still there. And if only the conditions were slightly better around us. The cost of living issues are with us here in the UK as they are across Europe, but they seem to have affected us more, and people have taken to the streets indeed, and loads of strikes over the last few months, which have cost the economy quite a bit.
Ryan, the IMF managing director, spoke about some of the challenges facing some countries. Let's listen to what she had to say, and I want to get your reaction on the other side.
We do have a significant inflation problem. That means central banks have to continue to keep interest rates higher to combat it, and that is on the way of restoring the prospects for robust growth.
How do you balance that, though? Because it seems like it's such a tough balancing act. We've seen the Fed here in the United States kind of pump the brakes a little bit recently because it's not necessarily an art, is it?
No, and it's not an easy road, Mike. I mean, when you think about sharpening monetary policy and further tightening, yeah, you saw it in the U.S., but you're going to see in other countries having to do that and having not to have that leeway as well. And when you think about the U.S. and how, if you use that as an example of how nominal wage gains are lagging behind price increases, and that you have to be on top of this every month to be able to ensure that the fiscal policy is there. Some of these other countries are not going to have that ability to control it to that exact T when things kind of go out of the control. And so I think it's key when you look at the global economy. For me, we all need many of these secondary markets and countries to be able to manage inflation as well. And it may be a little bit slower recovery, but that just means that the the larger economies in the world will also have to be slowed down too, Mike. There is this interconnectedness that goes back to the GDP expectations and forecasts. Just because the first world countries are back at a smaller clip, that doesn't mean that they're going to outgrow if everybody else is not in the same level and being able to handle the same problem. So I wouldn't be surprised when you see more help if it comes from trade or more help from other countries to be able to help stabilize a region for the benefit of everybody around.
Qiang, Chinese President Xi Jinping spoke about the Global Development Initiative to address the global governance deficit and other global challenges. Give us a sense of what he had to say and why these words matter.
Well, because currently we've been facing the common challenges as one human being. Just take a look at the questions and challenges we've been facing. Potential economic recession and also geopolitical conflict and climate change. If you take a look at the sandstorm recently, originated in Mongolia, and all this are telling me that one thing, we need to fight against all these challenges, from the nature or from our human society as one, united. So I think that's the reason why the President Xi Jinping has just brought forward about the GDI and the GSI and all the other initiatives like this. It's more than ever we need to, work as one team, not just to try to, confront anyone else. And that cannot solve the problem. So China is just to try to do its, fair share of the contribution. For example, as we mentioned, we've been doing the Belt and Road Initiative and also the Global Development Initiative, so that we can provide the value chain to the rest of the world, the services and products, and also we can just to fill in with a blank when probably when a certain part of the world is in the a challenging situation. So China and ASEAN countries and all the Eastern Asia plus the Middle East, we can just work together and to try to stabilize the rest of the part of the world. So we can make sure that the whole value chain, the capital supply, and also the geopolitical conditions can be still stable. Means when the rest of the part of the world is facing challenges, still some other part of the world can be stabilized. So we can make sure the whole world is still functioning and everybody still have something to depend upon.
All right, we're going to have to leave it there. Great discussion. Thank you all for joining us today and discussing the global economy. That's our conversation continues online. Chat with us about this or any of our shows on Twitter. We're at CGTN America, or visit us on Facebook. That's facebook.com/CGTN America. I'm Mike Walter in Washington, D.C. Thanks so much for being with us.
The nature of business is to bring value. Business activities in Europe